with the recent spike in the popularity of the stock market that brought us the Wall Street bets-powered GameStop rocket that nearly soared to infinity and beyond, one might wonder how something so spectacular came to be. Let's explore what enabled small Main Street investors to seriously cripple multiple Wall Street hedge funds. You may have seen or heard the term retail investor while reading or viewing news about the GameStop excitement. But what is a retail investor anyways? All investors can be placed into one of two groups, retail investors and institutional investors. To summarize an article by Barclay Palmer on Investopedia, a retail investor is an individual who invests their own money and who only invests small sums of money in comparison to institutional investors. By themselves, a retail investor has virtually no effect on the markets. On the other hand, an institutional investor is a financial professional who trades other people's money, most of which is individual retail investors' money. The amount of money that each of these institutional investors has under their control is massive in comparison to the retail investor. Mutual funds, pension funds, hedge funds, and investment banks are all examples of institutional investors. Since these institutional investors have control over hundreds of millions, or billions, or even trillions of dollars, they are the big boys on Wall Street who influence most of the market activity. Although the individual retail investor is small, the growth of the number of retail investors over the past 70 years is undeniable. According to a census conducted by the American Stock Exchange, which is now called the New York Stock Exchange, in 1952, only about 4% of the U.S. population owned common stock. Since then, that number has risen to 55% according to a 2019 Gallup poll. Many factors have contributed to this nearly 1,400% increase in the number of Americans invested in the stock market, such as the rise of mutual funds and the switch from defined benefit retirement plans to defined contribution retirement plans like 401ks. But the single biggest factor that has led to half of all Americans having some sort of investment in the stock market is the development of modern technology, specifically the computer. So what was trading like before computers? Trading stock in the 1950s was a long and arduous process compared to today's instantaneous process. If you wanted to buy a stock in the 1950s, you would first have to call your broker and say, "I'm interested in buying shares of company XYZ." The broker would then hang up the phone and walk over to the desk of the market maker in charge of XYZ's stock and ask for a bid-ask price quote. The broker would then give the pricing information to his clerk, who would call you back and tell you the current pricing of company XYZ's stock. If you decided you still wanted to purchase shares of XYZ, you would tell the clerk how many shares you wanted to buy. The clerk would then communicate your order to the broker on the floor of the exchange through a series of hand gestures. The broker would then go back to the market maker's desk and execute your order. What a long process, and that's not even to mention the trading fees. Compare that with the process of trading in 2021. Let's say you decided that you want to purchase shares of company ABC. All you need to do is find an online brokerage or trading app, create an account, transfer money from your bank account to your brokerage account, and then search for the company in the search bar and enter your orders. The rest of the process is taken care of by computers. It's a breeze, not to mention the fact that you get endless amounts of information on the company's stock just by typing the ticker symbol into Google. Oh, and it's also free. This computerization of investing in the stock market has increased the accessibility of the market and decreased the costs to nearly zero. These advancements have cultivated an environment that is much more favorable to retail investors than it used to be. But the catalyst that caused retail investors to band together and influence the marketplace in a way that was unimaginable just mere decades ago was the stimulus that the U.S. government injected into Main Street in response to the COVID-19 pandemic. A survey conducted by Deutsche Bank reported that 53% of those who received a stimulus payment invested at least some of the money into the stock market. But what will we see going forward? Was the GameStop excitement a one-time event, or will it spark a revolution in the way retail investors participate in the marketplace?